So, hi everybody. Thank you all for coming. Yeah, I will. Thank you all for coming. We have an interesting scenario where the outside of the room is filled. So I think we're going to start now, but we noticed that the outside of the room is completely filled and the table has some empty seats. So please come to the table and join us.
Pradeep, come to the table.
Yeah, you can't speak because, yeah, so please come to the table and join us. Great. As those seats are all getting filled, I'm going to start. I also wanted to just point out that this QR code that is passed around for those of you at the table, that's why you should all be at the table, that is the QR code for the guidance material that we're launching. So please also check that out if you want to see the actual material. I really want to welcome everybody. Good afternoon, and thank you for joining us today to launch the new guidance on sovereign SDG bonds, which was produced by the GISD, the Global Investors for Sustainable Development Alliance, under the leadership of UNDP and UNDESA together. My name is Sherry Spiegel. I'm the Director of the Financing for Sustainable Development Office at UNDESA, and I'll be your moderator for today's discussion. And to get started, I'm delighted to start by inviting Marcos Neto, the Assistant Secretary General and the Assistant Administrator and Director for the Bureau for Policy and Program Support at UNDP, to provide opening remarks. And thank you and your team for the excellent collaboration on the guidance material. It's always a pleasure to work together. And the floor is yours.
Thank you very much. Thank you, Sherry. It's a mouthful. I'm still getting used to my new title. It's delighted to be here. It's a busy week. I apologize that I'm not going to be able to stay for the whole time, but as much as I can. And I'm delighted to see so many old and good friends here. You know, Johan, Karen, Gavin, it's just incredible. Sanjay, good to see you. You know, it's fantastic to be here. Now let me read what people told me to read. Excellencies, ladies and gentlemen, it's, as I said, amazing to have you here. Over the last few years, the issuance of sovereign SDG bonds by governments to finance their sustainable development priorities has been increasing. More countries, like Uruguay, have issued bonds with UN support that have targets, KPIs, and projects linked to the SDGs. Sovereign SDG bonds are rooted in the country's need to finance sustainable development and an opportunity for countries to draw investments towards the sectors that need the most. Countries have started including SDG bonds in their country-led, country-on integrate national financial frameworks, a big name for a very simple concept: financial plan, financial strategy for your plans. That lay out the country's overall sustainable development finance needs. Now, an important partner in this is the Global Investors for Sustainable Development Alliance, a vision of UNDESA, Secretary General, and our colleagues from Sweden, you know, which are very thankful for your inspiration in bringing those private sectors players together in that sense. GISD, under the leadership of UNDESA and UNDP, has developed this integrated guidance for the benefit of sovereign borrowers considering SDG bonds. And investors look to scale up their investments through this instrument. So don't forget, we are carbon-free, paper-free, no deforestation, so go here. We analyzed 18 of our member states' experience, who between 2016 and 2023 issued $70.8 billion worth of sovereign bonds that include reference to alignment with the SDGs in the national financial frameworks. This analysis finds that issuing sovereign SDG bonds has the potential to offer benefits to countries, including providing a green union, diversifying the investment base, signaling a commitment to sustainable development, and enhancing the SDG impact of the domestic private sector. However, the process of developing and issuing a sovereign SDG bond involves many complex and technical challenges for developing countries, such as multi-stakeholder coordination, mitigating greenwashing in terms of identifying projects and KPIs, monitoring reporting, and issuance in domestic markets. In addition, high debt levels, market risk perceptions, and borrowing costs can make issuance unfeasible for some countries. UNDP has a track record of having participated in supporting countries on over 27 billion in sovereign thematic bonds issuance, and to collaborate across the private and public sector to support countries overcoming the issues and the challenges that we've seen. UNDP support helps developing countries unlock financing within a context of high interest rate and lack of fiscal space. Additionally, local investors are increasingly looking at buying sovereign thematic bond, thus deepening the local financial market. The guidance that we are issuing today turns to analyze investors' preference around sovereign SDG bonds. The results shed light on the decision-making process behind investing in sovereign SDG bonds, pricing risks, preference between different bond structures, and data and impact. The guidance provides key recommendations for the UN system and the MDBs, the multilateral development banks, to help identify sustainable development gaps, foster collaboration, and enhance transparency. Also, to donors, the study recommends scaling up the credit enhancement when appropriate, building institutional capacity, support a long-term approach to ratings. And to the private sector, the main takeaways are for open communications and engagement with countries, to pool countries in the portfolio, a fund, and ensure transparency of deals. Critically, I want to emphasize the value added by this work to the ecosystem of sovereign thematic debt and delivering the SDGs through these instruments. Important to the development of this guidance is the role of the UN in bringing countries and investors together as a bridge between the private and the public sector in helping these countries better access the international debt capital market. Looking ahead, the demand in the countries to which the UN is responding to is only expected to increase. And by working together, the UN will continue to help countries bring the SDG aligned investment opportunities to global markets. I extend my gratitude to UNDESA for co-hosting this event, and above all, for our long-standing and partnership. You know, we couldn't have done any of this work without DESA. We couldn't have done most of the work that we do as UNDP on INFF and everything else without DESA. So I'm very, very profoundly thankful for the partnership with DESA. And I want to thank ahead of time the distinguished panelists, my dear friend Sharon, who moderates like nobody, and you're going to see that soon, right, for their attendance on this important event. Let me just tell you finally that the capital markets, there's a lot of money, and they're looking for instruments like this. They are looking for the right type of instruments that provided more than just a financial return. That is what we are trying to do here. Help countries tap on an enormous pool of money, right, that they are looking for in the right way, at the right price. Thank you very much.
Thank you, Marcos, and thanks. And the warm thanks are back to you for the collaboration, because we also couldn't do our work without working closely with UNDP and really utilizing the entire system working together in a way that is, I think, something that in the past few years, or past 5 years or so, has really been an excellent, grown significantly and been an excellent collaboration. I also want to thank Sweden for your generous support in this work, and for all the support you have provided up till now. And because again, this work would not be happening without the collaboration with Sweden, both for the technical collaboration and the work together, as well as for the financial support. So thank you very much to Sweden. And I now have the pleasure to invite Ms. Lisa Bjungstam, did I get that right? Okay. Deputy Director General, Head of Department for Multilateral Development Banks, Sustainability and Climate from the Ministry for Foreign Affairs of Sweden, to provide the keynote address. So thank you.
Thank you so much, Sherry, for those words. And really right back at you. Thank you so much for our collaboration and for helping us in organizing this event. Ladies and gentlemen, distinguished guests, good afternoon. It is really great to be here. It's a huge pleasure for me to be able to set the scene or give some more context or background for this event on SDG bonds as a tool for increased private investments for sustainable development. It's an event co-organized by UNDESA, UNDP, and Sweden, and of course with the participation of the GISD Alliance. And I want to take this opportunity to thank everybody for the close, the very strong, the important collaboration in this process and on this event. So thank you so much. Above all, again, a warm welcome to all participants today and to all attendees in the room. I'm very glad to see so many participating. Well, we're gathering in New York this week to discuss financing for development and how to catalyze financial flows and financial action for the Sustainable Development Goals. We have passed the half-time of the 2030 agenda. We're not on track to fulfill the SDGs, and we know that the time gap is closing. In meeting with these and other challenges, the issue of financing is key, and we need to attract investments and develop effective investment tools that can catalyze capital at scale for sustainable impact, from infrastructure and climate action to broader reforms in the countries that need them. The good news in the field of financing is that in the global system there are financial assets to underpin the Sustainable Development Goals, more than enough. Estimations made by the OECD show that only a few % of the total financial assets would be enough to bridge the finance gap, which is estimated to $4.3 billion, only 1% of the total global wealth. And there is a growing trend for sustainable finance and sustainable investment generally, driven by customer demand and regulatory and investor pressure. We know that many multinational companies are working to promote greener behavior across their supply chains. Investors and creditors are also increasingly lining up to support investment in the green transition, for example, renewable energy. However, this development is uneven across regions and in and between countries, and investments are not sufficiently reaching to where they're needed the most. There is scope to further promote these aspects, including the ease of doing business and a conducive business climate, especially in least developed countries. Engaging with financial actors is fundamental in order to advance concrete tools for increased investments with a sustainable impact. In 2016, Sweden initiated a dialogue with what was to become the Swedish Investors for Sustainable Development, a network that brings together some of Sweden's largest asset owners, asset managers, and institutional investors in order to explore the investors' role on the SDGs. And we did this early on. This dialogue became the starting point for a collaboration with UNDESA and a similar investor network with global reach, the Global Investors for Sustainable Development, the GISD Alliance. Now, turning to the country perspective, many countries are working or starting to work on integrated national financing frameworks, the INFFs. Marcos also mentioned them in his remarks. This is a country-led method, and I think this is important to point out. The country is in the driver's seat. A country-led method on how to optimize financial flows to the specific country, both internal and external flows. It lays out the full range of financing sources, domestic and international sources of both public and private finance, and allows countries to develop a strategy to increase investment, manage risks, and achieve sustainable development priorities. Following this process, some countries have come to the conclusion that they would like to attract international investors by issuing SDG sovereign bonds. In this space between investors wishing for new instruments that can accelerate the capital invested and reduce risks, and countries needing more external finance at scale, Sweden, UNDP, and UNDESA saw converging interests and the possibility for a fruitful public-private dialogue. A first official side event was organized at the FFD Forum here in New York last year, and I know some of you participated. Today, we are very proud to be part of the launch of the report, the SDG Bonds Guidance, and to organize this discussion on the way forward for SDG sovereign bonds and other SDG-related bonds, to discuss benefits and challenges on the basis of the conclusions and recommendations in the guidance. Sweden sees the launch of the report as a starting point for discovering and developing a sound, responsible market for instruments for financing sustainable development in developing countries. We believe that SDG sovereign bonds, cautiously and responsibly designed, considering the importance of debt sustainability, can be an instrument that channels large and long-term investments for countries. SDG bonds can help countries to align budgets with sustainable development. To conclude, as a major donor to the UN system, the multilateral development banks, and the global climate funds, Sweden seeks to strengthen synergies between development cooperation, trade, and innovation. This approach, including a strengthened partnership with the private sector, not least to unlock the potential of the green and the digital transition, lies at the heart of Sweden's recently launched reform agenda for development cooperation. We believe there is much to gain for countries and private and public actors when combining development cooperation, trade, and investments. We will continue contributing in the discussion on efficient tools for how to mobilize additional private capital, drawing on the potential of the green and digital transition in support of sustainable growth and the SDGs. Sweden will remain engaged in the forthcoming discussions leading up to the FFD4 conference in Spain, and we do look forward to working with you all. Thank you again, and again to the co-organizers. Thank you so much. Looking forward to the discussions.
Thank you so much for that keynote. So colleagues has to unfortunately leave, but thank you for your contribution, and UNDP is not going anywhere. All right. So I'm now going to, before we go into the panel discussion, I'd like to invite Gavin Power, Chief of Sustainable Development and International Affairs at PIMCO. I don't know, does everyone here know PIMCO is Pacific Investment Management Company? That's right. But I think they are the biggest, is that correct, bond investor in the world? Among the largest, so maybe I'm giving them. And also Karen Svensson, Senior Advisor and CETA's Project Lead for the GISD Alliance, to provide a brief presentation of the key findings and recommendations of the guidance on sovereign bonds. Both Gavin and Karen acted as advisors for this work, and we are very grateful for their continuous comments and feedback throughout the process. So over to both of you.
Thank you, Shari. I wanted to start off by saying that the work with this guidance, this SDG Sovereign Bonds guidance, has been done in a very collaborative mode, with interviews with countries that are working with INFFs and having issued SDG Sovereign Bonds, and with engagement from GISD, UNDP, UNDESA, and Sweden through SIDA. So thank you for that. And we think that this great collaboration comes from the fact that the SDG sovereign bonds is a truly catalytical financial instrument. It has the potential to attract large assets for finance, for sustainable development for the countries, to align budgets with the SDGs. And it has also the potential to help investors align their portfolios with sustainable development. And one beauty of the SDG sovereign bonds is that they can also attract finance to social areas and social SDGs, and also in addition to climate and biodiversity and infrastructure finance, of course. Today is the graduation of the report, but like for all graduations, it's only the start of something bigger, more beautiful, more impactful. Now we need to discover how the SDG sovereign bonds market can advance and develop further. What is needed in terms of technical support and capacity building, maybe in the countries, maybe for the investors? How can we involve other UN agencies? How can investors learn more from the country needs? And how should responsible and cautious SDG bonds issuance be performed? We need a discussion also if blended finance is something that is needed to support some of the countries for some SDG sovereign bond issuances. And we need to discuss how the whole market of SDG bonds, including corporate bonds and other bonds, can advance. Because SDG sovereign bonds and other SDG bonds are tools for the new financial architecture that is going to be discussed these days and is discussed these days. So let's continue in this collaborative mode together in partnership, and Sweden will be pushing. So over to you, Gavin.
Well, thank you indeed, and it's wonderful to be back in the UN mothership where I worked for many, many years and see many old friends and colleagues, and to join my dear friend and colleague Karin on behalf of GISD for the launch of this important guide. And my compliments to UNDESK and UNDP for helping us get to this milestone today. Just perhaps 3 overarching points before we dive into a few slides on the guide. First, more than ever, we think it's critical to see the SDGs as an investment agenda. I mean, that's clear, demanding public and private capital mobilization at scale. We're seriously off track in terms of the SDGs, but they're still achievable if we have this step up, this real step change in finance and investment, and the capital is there, as Marcos said. Second, and related, I'd like to call on several very specific UN public-private initiatives, a few of which I had a modest hand in, to deepen their collaboration and coordination. Each is valuable in its own right, but together I think they could be even more impactful and powerful. GISD, the UN Global Compact CFO Coalition, UNEP-FI, UNDP Impact, and UNCTAD Sustainable Stock Exchange Initiative. I think their partnership will be essential in the lead up to FFD in 2025 and beyond. Third, and especially related to the guide, the investment community must begin to see the SDGs as representing a new asset opportunity. SDGs members have argued, and to fully endorse the concept of sustainable development investing as defined by GSD. So I encourage you to read that definition. This framing, in our view, will help organize investment decision-making and relevant strategies and asset allocation across public and private markets and help us get above the turbulent debates around ESG investing. So with these brief words, let's turn to the guide itself, if we may. Here are a few background points. The core objective of the guide is to give a boost to SDG financing and SDG stimulus by helping to create a mainstream market in sovereign SDG bonds with debt sustainability as a top consideration. The guide covers emerging best practices in bond issuance, including case studies, and finally, key recommendations to sovereigns, donors, the private sector, and other actors. In terms of the scope and methodology, the guide is based on interviews with both member states and the private sector. A survey of investor preferences and considerations is included, mindful this is a fairly new and nascent market with great potential. And a broad expert group consultation. The guide includes key references in this regard in terms of the experts that were consulted. The guide suggests a range of benefits and challenges for countries, which I'm sure the next panel will discuss in some detail. On the benefits side of the ledger, a potential cost of capital advantages, appealing to new investors, and SDG impact in terms of challenges. General issues are identified from SDG impact, concerns around reporting, and debt sustainability, as I mentioned. Karen, perhaps to you for a few additional slides.
Yes. So, continuing a little bit on the best practices for countries, and I'll go really quick through this because we don't have so much time and you can read the report. But it's important, of course, for the countries to discover suitable conditions if the country is suited for issuing SDG bonds yet, or taking on more debt, or if it comes later in the cycle and within the upcoming years. And to be pointed out here again that we need to move cautiously in this field, not going into troublesome debt situations for individual countries, of course. And then UNDP has a section with this very instructive different steps that the countries can go through before issuing an SDG sovereign bond that you can look through also. And then going into preferences for the investors, they need to price risk and need to think of different bond structures, of course. But very important for investors is this dialogue with the countries, engaging with governments to understand their development gaps and investment needs for sustainable development, and undertaking independent due diligence and ensure alignment with global standards. So going into the last slide before the panel discussion, there are also recommendations for the UN and for the MDBs to be helpful and identify sustainable development gaps for the countries and maybe even for the regions, and enhance transparency and reporting within this field, and for donors also to look into the possibilities of giving guarantees and blended finance to some of the SDG sovereign bonds and build institutional capacity within the countries. So I'll stop there. And again, a partnership is needed to advance the potential of the SDG sovereign bonds and other SDG bonds for prosperity, people, sustainable development, for making sustainable development an asset class for investors. And Sweden will continue on this endeavor. So back to you.
Thank you both so much for that overview and presentation of what's in the guidance. And we're now going to go to the panel discussion. We have 4 really, really excellent speakers. So we have 2 from the private sector and 2 from the official sector. So we'll start with, I'm going to just read the names so everybody knows who they are, and then we're going to actually have a back and forth with questions and answers rather than presentations. So there's Sana Merha, who is the head of emerging market sustainable debt capital markets from Citibank. And then there's Andrew Karup, who is the global head of sustainable banking solutions group from Bank of America. Then there's, I'm looking the wrong way. There's Andrew. Sorry, apologies, everyone. There's Andrew. Then, looking the right direction, I hope. Yes, I'm looking the right direction. Okay, Sonar Luvsan George. Very good. Sorry if I'm just destroying your names. Director General Financial Policy Department from the Ministry of Finance from Mongolia. And finally, Vivi Yul Aswati, who is the Deputy Minister for Maritime and Natural Resources from Bappenas, the Ministry of Planning from Indonesia. So our excellent panelists, apologies for looking in the wrong direction and all. But we're going to start with the first question is just to talk about the wider benefits of SDG bonds to you. And let's start with the 2 private sector entities, and then we'll go to the two countries. So if you want to start, yes, for Sana.
Firstly, thank you, and I want to extend my congratulations to the UNDP and DESA team for a really fantastic report that summarizes the key issues of issuing SDG bonds, and I think some excellent case studies for practical and with practical recommendations. So in terms of what are the main benefits of issuing SDG bonds, so I see them threefold. One is it's a fantastic signaling tool for sovereigns to talk about their how is sustainable development a priority to them. It's a way, by issuing SDG bonds either in use of proceeds or KPI-linked format, they're able to also highlight specific projects that they'd like to showcase to investors, flagship projects that they're undertaking. It's also great not only to investors, but to their other stakeholders, their own citizens, their own civil society, about their how sustainable development is a key priority for them. So first is signaling. Secondly, I would say is engagement, engagement with investors. Usually when we take a sovereign for a roadshow, for a conventional bond transaction, they'll be talking about the general credit metrics, the credit profile of the country, and economic indicators. But when we take them on a roadshow for an SDG bond, you really get into a lot more of an in-depth discussion with the investors. They'll be talking about the sustainable development priorities, the gaps, how they're fitting in, how they intend to fill those gaps. It is a lot more work, both for the investors, the ESG analysts that come to the room, as well as the sovereign in putting more detail that they need to discuss with the investors. But in most cases, we find both parties find it a very fruitful discussion. It's a more engaged, a more in-depth discussion than for a normal conventional bond transaction. And this leads to what the report highlights is investor diversification as well. So other investors that perhaps did not consider them did not come into conventional bonds really are then enticed by the sustainable label or they can bring additional money that is separated for sustainable funds. So engagement is really key, which leads to investor diversification. question. And then thirdly, I would say it's usually, when a sovereign's issuing a SDG bond, it's usually the first time that they are tagging budgetary expenditures to SDGs. And this helps them put together structures, governance procedures in place to think about how is finance flowing towards the SDGs. So I think it's a great tool. Most issuers that we've spoken to will say it is a painful process, but no one's ever complained, they really value the benefits that come out of it. So from a structural perspective, that multi-stakeholder coordination comes into play, and then they can take that forward and think about, once they have the reporting structures in place, they can then think about what are the future strategies, where are the areas that are being funded, where are the areas that are not being funded, and take policy decisions based on that.
Thanks. And a quick follow-up question. So when you talked about investor diversification, can you talk about the types of investors you see most interested, and if that's changed as this market has developed?
Sure. So I would say the big asset managers, of course, are key drivers. You will see, it's quite interesting, actually. I just had an interesting anecdote where, when our syndicates and our DCM teams will pitch sustainable bonds, and then when you go on the road shows, the sovereigns will expect to meet new investors. You're not usually meeting new investors. There is not a pool of secret investors hiding. So it is your large asset managers, but they're able to actually, their growing portfolios within the asset management are now dedicated towards ESG financing and sustainable investments. So usually you will have the normal credit portfolios come in, but by issuing a sustainable bond, you're then able to access the additional demand from usually the similar investors, but from their sustainable portfolio. So I say the large asset managers. I think central banks as well are playing a key role, and they have set aside green bond portfolios that you can see as well. Bank treasuries as well that can buy sovereign bonds are looking to integrate ESG considerations in their treasury portfolio. So you will see them come in as well.
Thanks, Andrew. Question for you. Same question.
The hard part is going second, actually, because Gavin, Karen, Sana, Mr. Neto covered a lot of the points that are most relevant. So maybe I'll highlight and re-emphasize a couple of points that Sana made, and then maybe add one little wrinkle on top of that. And maybe the first thing actually I'll say is I'll just answer the question you just asked around investors. There's definitely a growing pool of capital that is specifically looking for impact. So obviously returns as a primary driver, and we'll talk more about that later, but there is a growing pool of capital that is looking for impact. And the ability for investors to assess that impact and measure and report out to their own end users is a critical element for that. So being able to, for an investor, being able to access securities that provide them with that type of information is super critical. So I'll just kind of make that point as a benefit of the guidance and how you attract investors. In terms of the benefit of the broader product, I think my perspective would be largely aligned with what you heard in terms of the signaling impact that Sana mentioned, the importance that has in particular, and Sana also referenced this, but just to highlight, I think the signaling impact that has to internal stakeholders. Obviously, there's an impact externally, but to internal stakeholders on the seriousness and the rigor now attached to achieving whatever targets or projects have been set. There is a little bit of incremental pressure that's placed when you make an external statement that you now have to live up to, and that we found that galvanizes activity. Actually, we see that in our own organization in the instruments that we issue when we challenge our teams internally to find projects. Lo and behold, you end up getting a total that's greater than the sum of the parts. So I think that's critically important. I think the other element is that it does, I think, establish a level of credibility with the investment community. Undergoing one of these programs, as the guidance highlights, takes effort and work, and it's not without cost. And the willingness to merely undergo that activity and to adhere to the rigor that's required helps establish a level of credibility in the market that issuers can leverage and take advantage of. And then maybe that's just the last thing that I'll say, which I'm not sure has been mentioned. I do think there is an element of the more activity there is in the market, it generates more activity. So you create this virtuous cycle. And so the sheer act of issuing the bonds expands the size of the market, which attracts more investors, which then allows more issuers to access the market. So it becomes a little bit of a, as I said, a virtuous cycle. And somebody has to kind of take those initial steps to help develop the market. So I think that particularly at this stage, as we talk about kind of filling the gap, allocating the capital and getting it to the direction, the places where it needs to be, those taking those initial first steps are super important.
A follow-up question for you is, what about pricing?
Yeah, what about pricing? So, there are various studies that have been done on the so-called greenium, right? The incremental pricing benefit that you get for issuing a security that has some type of SDG theme to it. And you can look at a whole bunch of different studies. You can look at it in different ways. And basically, I think what our analysis shows is that it can be anywhere from 1 to 5 basis points of savings. Not insignificant, but not, in my opinion, not driving the activity in and of itself. So I think for sovereigns that are going into this purely for the goal of establishing a pricing benefit, I think that to me that's the wrong way to think about it. I think the way that you're supposed to think about it is doing this to attract incremental pools of capital, as Sana said, to establish credibility in the market, to help develop the market, to ultimately provide a more robust funding program. And if you happen to get a modest pricing benefit, then so much better.
1 to 2 basis points versus how much in costs, would you say?
Versus how much in incremental cost? I think.
Yeah.
Well, I think that savings offsets the cost.
Right, okay,
I think that's fair.
Thanks. So
Yeah.
let's go to the public sector, the two public sectors. So I'll start with you, Vivi, for the same question on how you see the benefits.
First of all, thank you very much for this opportunity to discuss the very important topics. For Indonesia, actually, it is part of our effort to accelerate the SDGs achievement by issuing the presidential decree to encourage innovative financing platform. So 3 benefits for us, for sure, is to accelerate the capital market deepening, to unlock financing opportunities, and then also to improve the other side on public spending to incentivize the private fund mobilization, and to improve impact investment mobilization by implementing impact measurement and management practices. So based on this, and of course we also part of the INFF development. Starting in August 2021, we have issued the SDGs bond for the first time, only 500 million euros. And then after that, we expand it and improve it to expand also with the blue bond. This is along the line with our government financing strategy to diversify the financing instruments and broaden the investor base. Of course, there are a couple of concerns and also challenges. First, we have to have a strong commitment and collaborations among relevant parties, especially for budget tagging, and also on the preparations of issuance of requirements, such as the development of the framework, review it, by the second party opinion and aligned with the budget tagging, which is applied to only a year in the implementations. And also, like you have already mentioned on the pricing benefit, it is expected that the issuance of thematic bonds will yield a pricing benefit. And now we are progressing, I will say, to prepare the non-sovereign bond, working together with, for example, World Bank for the Coral bond, as well as with the IIX for the orange bond, for the goal number 5.
For the what? I'm sorry?
For goal number 5.
Great.
Thank you.
Great, thank you. And one question would be, in the budget tagging, do you think that this has led to different budget has it led to a change in your allocation? Or is it just, this is what you were going to do, so now you're tagging it? So do you think it's actually changed the incentives of how you are thinking about your allocations?
Yeah, like I mentioned earlier, that this mechanism improve the public spending qualities. They could make more focus on the spending. For example, we expand it not only on the green tagging, which goes to the renewable energy, energy efficiency, sustainable transport, waste to energy and waste management, and many more. We also improve on the context of the social focus, like employment generation, socio-economic advancement and empowerment, food security, and sustainable food system, access to essential services, affordable basic infrastructure. And it's really benefit us to improve our e-planning and e-budgeting to make them in coherence way.
Great, thank you so much. So, Sonar, question to you as well.
Thank you so much. Is it on?
Yes,
okay.
It should be, it's right.
Well, first of all, I would like to thank UNDP, UNDESA, Swedish government, and GISD for organizing today's event and having me as a panelist. So Mongolia also started the INFF back in 2021. And when we were first doing the analysis under the INFF, we found out that in order to achieve the SDG by 2030, we would need to have at least equivalent to 18% of GDP investment in order to achieve it. So it was a very high financing capital need. And the SDG bond is one of the instruments to achieve the goals. So for us, I would just like to give my own example. So I've been handling the government's bond issuance funding for over 10 years now. And the first time I've encountered the SDG bond was back in 2018. So I was in Japan, meeting investors, the private pension funds and mutual funds. And one of the investors asked me, do you have an ESG in the meeting? And because it was my first time, I asked, what is ESG? And he told me environmental, social governance. And so since then, we started to look really closely into the ESG, green bonds, social bonds, and SDG. And together with UNDP, we have drafted and got the approval on the SDG bond framework. So we got the second party opinion from S&P. Now, of course, at this stage, we didn't issue an SDG bond yet because we had certain challenges from the legal point of view at that time. And in order to avoid those, now we are working again with UNDP and also the Asian Development Bank in drafting the SLB framework, so more tied to the KPIs, sustainability-linked bonds. And during these, so we conduct investor meetings, roadshow on a continuous basis, so at least twice a year. So just earlier today, we hosted an investor forum in New York. And there were a lot of discussions from the investors about the green bonds as well, about the energy transition. So over the years, when we were engaging the investors, the number of questions related to the green bonds have been increasing drastically. So back in 2020, when the COVID just started, there wasn't much questions at the time. We were doing investor meetings on Zoom. Actually, PIMCO is one of our oldest investors. So and we did the latest roadshow in November. So our latest issuance was in 2nd of December last year. We tried to do an SDG bonds, but there were several issues. I think we can discuss about those later. And at that time, especially from the European investors, there were a lot of people asking, why not just do an SDG bond right now? So I told them we were working on SLBs with the KPI at the moment. And we find it's a great tool to fill the funding gap. Secondly, we also look very carefully at the investor diversification. So, and all of the private sector participants already mentioned, so I don't want to repeat them, but the investor having a larger pool of investors, investor base, having more diverse range, and having the right signal into the market, because Mongolia is a mining country. So our main exports are copper and other minerals. So the signaling to the international market when we have an SDG is also a big benefit. So those will be a few items.
Thanks. And I think that our colleague from Indonesia already mentioned some of the challenges, so maybe you want to also mention some of the challenges you've envisioned have as well.
Okay. Well, in terms of the challenges, even though we've been looking into issuing this bond since 2018, we still haven't issued yet. Now, the first thing was, in 2017, our debt to GDP ratio was over 80%. And at that time, we've engaged with the IMF and other multilateral and bilaterals, and we've entered the program. So until this point, the achieving debt sustainability has been the main agenda for the Mongolian government. So from over 80% of debt to GDP ratio, at end of 2023, we were able to achieve under 40% debt to GDP ratio, so it's 38% in NPV. And we also, our parliament, every 3 years, they approve a medium-term debt management strategy. And within the strategy, it clearly stipulates that every new international bond issuance needs to be only to refinance the existing debt, so pure liability management. So if we wanted to issue green bonds, at that time when we had the framework, it was more designed towards use of proceeds, so which means we will need to raise additional capital to finance these specific projects. But our parliament document clearly says that you cannot do that. So that's one legal challenge. Secondly, second one was the debt to GDP ratio we wanted to achieve. Third, in terms of the cost benefits analysis, the overall margin between the green bond or SDG bond or our conventional bonds was very minimal. And of course, there are other issues, like we're now working on implementing the budget tagging as well. And also the reporting and standards will be met. And also, in the past, the Reg S 144A, the regular bonds, are issued by the Ministry of Finance. We look after the redemption schedule. But with the SDG bonds, you have a lot more stakeholders. We need to work closely with the Energy Ministry, with the environment, and we need to coordinate all of our efforts. So we've been doing that through the INFF, and also our domestic market has been also improving on that sense as well.
Great, thank you. And I think it both highlights how INFF's bringing the different parts of the government together and how critical this is, and also that that SDG bonds are not for every country, and that their debt sustainability is critical first, and then so that it's really a case of an instrument to be used in the appropriate circumstances. So thank you so much for that. Sana, what do you think the needs of the private sector have that are not currently being met by issuers and other market actors?
I'd say first, from an investor perspective, they would love standardized criteria on what is an eligible green project. This makes it easier for their systems to compare what is best practice, to compare one SDG bond to another. But however, in reality, that's not possible. Each region and each country will have local nuances that they need to take into account. They need to take into account just transition. So it's not fair to it's not fair to endorse one sort of eligibility criteria on every sovereign, etc. So they would prefer standardized eligibility criteria, but that's not available. So it becomes the job of the sovereign who is issuing the SDG bonds, where their eligibility criteria differs, is to really explain why that's the case. What are the nuances that investors should take into account? Because it's, again, from a practical perspective, you need to see that ESG analysts are resource constrained at the investors in the private sector. They're looking at several different countries, several different geographies, so they may not understand the nuances, but that doesn't mean that they're not ready to engage. They want to learn from you, and again, a SDG bond is a great way of having that dialogue and making sure that they are aware of the key priorities, the key challenges for the country, and why criteria might have to differ from what is commonly seen as best practice. The second, I would say, is the report talks about the lack of standardized impact reporting. So for green projects, it tends to be easier because you have renewable installed capacity, you'll have greenhouse gas emissions avoided as impact metrics. But for social projects, when your sovereigns are allocating to that, there aren't standardized impact metrics. They will use different impact metrics, they will use different methodologies. So again, one complaint that we see from investors is there's no standardized impact reporting. It gets very difficult for them to aggregate impact data based on all their sustainable investments. And then it becomes challenging for them to report on the impact of their investments to their end clients. So they would like to see, and there are several initiatives, such as the EU Green Bond Standard, ICMA have reporting templates. They're not being widely used, and it's our job, and I think to work with MDBs to try and standardize impact data where possible. I just make the last comment is investors also want to see sustained supply. I think this was mentioned. To be able to be continually active in this market and to build sustainable bond or sustainable sovereign bond portfolios, they need to be confident that you're not going to just have one issuance, that sovereigns are going to be issuing are going to be repeat issuers, and sustainable and SDG bonds are going to be part of their overall funding programs.
Great, thank you. And before I get to the question on SDG washing, which was a natural follow-up, I think, from your first 2 points, on the third point, instead of Andrew asking you the same question, I'm going to ask.
You changed it up on me. Okay.
Yeah, I'm going to change it up in here. I'm going to just ask a question following up on the point on the markets. One thing that's really interesting to me is when you, as an investor, you're always looking for, we're talking about this as an asset class possibly, and you're always looking for asset classes. How do you define it? By its correlation with other asset classes, and how that it's not correlated. And how do you see the correlation of this with sovereign bonds? Just a question, yeah.
Actually, I think it's going to be highly correlated, right? The key risks in each of them are the same. The difference between the two is primarily the impact that you get out of one versus the other, and the alignment of that with the investor's goals. And if you think about, and maybe I'm not sure if you were going in this direction, but if you think about what it is an investor is looking for, it's really quite simple in that they are seeking the opportunity to invest in assets that align with their goals and the goals of their end users and the mission that they have defined as such, and achieving an adequate return for the risk that they're taking on those assets. And I would just highlight, and I know this isn't exactly what you asked, but I'm going to just go there because I want to make this point. One of the things I think that investors will struggle with oftentimes in these situations is, in fact, that and the risk-reward dynamic that is associated with the issuance for many of these securities, and therefore the cost that would be associated with issuing, and at times that can be onerous for the issuers. So how do you kind of bridge the gap of the risk reward that the investors need with a cost that the issuer is willing to pay? And there are a couple of techniques, strategies that you can deploy, certainly ensuring that debt sustainability, as Sonor was saying, that debt sustainability is addressed is a key element. I think, again, investors want to see the ability for an issuer to certainly be able to service their obligations and to be sustainable over a long period of time. The other obvious element is some type of insurance and credit enhancement. The guidance has specific reference to donors and the importance that they play in this ecosystem, and I do just want to highlight that I think that is an element that is critical to the expansion of the market, and the growth in the ability to issue these securities is creating that risk-reward dynamic by putting the overlay of some type of credit enhancement into these instruments, and having the sovereigns have access to that type of opportunity is critically important for bringing together what the investors want and what the issuers want.
Great, thanks. I was actually just thinking that maybe if you have a slightly different investor base, that there may actually be a slightly different pricing or market activity or selling.
That as you increase the number of impact-focused investors who, in theory, would think about trading return for impact, I think the reality is that in the market today, there aren't enough of those to sufficiently offset the pricing dynamic in a broad context.
Thanks. So we're running up against time, but I want to go to the next question for all four of you, which is the question of greenwashing and how does one mitigate, or SDG washing, and how does one mitigate that? And so, Vivi, what your thoughts are on that?
I think one of the key elements is to prepare the underlying project selection criteria, among others, including that we focusing the use of the bond only for the national priority and the strategy to achieve the SDG targets, and then also the values is quite large. In the case of Indonesia, we set as much as possible above 100 billion rupiahs, and also because it is worth it to measure the impact, and also the programs is relatively stable, meaning its continued implementation in the following years, despite that the cabinet is changing, and it is due to the SDG bond tenor is around 12 years. And no duplication of financing with other sources, so it also make measurement is easier, and meet the exclusions, i.e. Exclusion criteria, i.e. the luxury sectors, child labor and forced labor, weapon, fossil fuels, nuclears, and hydropower projects exceeding 30 megawatt, for examples. The other things is about the data availability. I think we have to build a commitment as well as collaborations with related ministries to start to build the SDGs targets and indicators data, which is not always available. It could help us to strengthen the impact measurement. So for the context of Indonesia, it's really, in the report, we could show that the bond is really accelerate us to achieve the some SDGs indicators and the targets. Thank you.
So now from your side, and also you might want to also think if you have thoughts on that haven't been mentioned yet, as well on greenwashing, as well as ideas you can have if you've thought about scaling up the market. You might not have thought about that yet because you're still thinking about the first issuance, but if you have thoughts on greenwashing as well.
Thank you. Well, before we issue, of course, we are thinking about greenwashing because in our, maybe I can just give some example from our private sector, because our private sector, the banks have been very active in terms of issuing the green bonds, providing green loans in the domestic market. So there's a Financial Stability Board, which comprises the finance minister, central bank governor, and others. We've developed and approved the green taxonomy back in 2019, and the SDG Sustainable Taxonomy in 2023. So in accordance with the taxonomy, now our private sector is providing green loans, and also our Financial Regulatory Commission also approved the green bonds regulation for the private sector. So from these experiences, we've also experienced a certain level of greenwashing. Even though the share of banking sector's loan is greening, there is also some greenwashing elements. So now we are trying to work more on the green taxonomy, how to negate some of these greenwashing elements. From the public side, our framework from the Ministry of Finance is we drafted in alignment with the ICMA principles, the ICMA Green Bond Principle, Social and Sustainability Bond Principles. And before we raise any funding to fund these projects, once the Parliament document is done, the timeline, we need to have project preparedness as well. So having the projects that has the right feasibility study that are aligned with our framework, that also takes some time. And actually, Vivi also talked about the data. Right now, we are drafting the SLB framework, and same problem is also with us. When we are looking at different, whether it's carbon emission, the trees or lands, how we can do the carbon sequestration, the data that's available, it's also limited. So we're having also certain difficulties. So so these will be some of my points. Thank you.
Thank you. Sana, for you, if you have anything to add on greenwashing, so just to add, and then also if you have thoughts on the way forward in the market.
Sure. I think one thing I would add, and Citi provided some data for the report, where it's important to know that sustainable use of proceeds bonds are not appropriate to finance all types of SDGs. So as mentioned by Vivi, they chose a certain limit of budgetary expenditures to be eligible for use of proceeds financing. So that shows it's only really the large budgetary items that get financed by SDG bonds. So for green use of proceeds, typically a sovereign would finance sustainable cities. That is usually green buildings or clean transports or electrification of railways. For social, it's poverty alleviation, decent work. So that's usually SME lending. Is done through providing access to essential services like affordable housing. So those are the big budgetary items that we see. There are some SDGs like gender equality you'll see there is not financed by SDG bonds. That's because the amount of budgetary expenditures you need to put policies and programs in place to improve gender equality metrics are not as large as budgetary expenditures and capex for example, railways, etc. But one thing I think sovereigns could do better is for the SDGs that are not being financed by budgetary expenditures, is to talk about social co-benefits of the budgetary expenditures that are being financed. So if you are connecting rural communities through the railway system, how is that impacting women, for example? The proceeds that they're going towards access to education, how is that impacting girls in schools? So they can report on the social co-benefits of the expenditures that they make, and also potentially for some SDGs, the use of proceeds model isn't appropriate, and they may want to consider sustainability-linked bonds. So like in the case of Chile, where the use of proceeds are for general purposes, but the coupon is linked to gender equality metrics, which may be more appropriate. So it's thinking about what are the SDG gaps and what is the right type of SDG bond as well.
Thanks. And finally, over to you.
I know you're short on time, so I'll make 3 quick points. I think you clearly need a rigorous program of governance and oversight that involves contributions and coordination across multiple stakeholders, external and internal. You need to make sure the projects and the targets that you're choosing are achievable, but also impactful and real. And you need to ensure that there is the appropriate alignment across all levels of the government. Soner talked about the integrated effort across various elements, and everybody has to be aligned on the importance of achieving whatever is set out in the transaction so that you can assure that you have the best chance of achieving that.
Great, thank you for that very succinct closing. And we now want to open the floor for questions and comments and thoughts from all of you. And raise your hands quickly because we don't have much time, but you must have some ideas and thoughts to add to this. Yes, go ahead.
Good afternoon, parties and Sherry Spiegel. My name is Gail Davis. I represent several several civil society organizations and some member states. I have a question. Can the SDG bonds be used to finance infrastructural or digital, the digital divide in countries that may be on the World Bank's top 10 list as the poorest countries in the world? And number two, can they also be utilized in some, what we might think is middle income countries, but they still need the help? Can those be used in either area, especially for infrastructural needs? Thank you.
Thanks. Are there other comments or questions? Just because we're running out of time, we could lump some together. Well, let's go to who amongst the four of you would like to
Question. I think the answer is largely yes. Credit enhancement would certainly help in the case of the least developed countries. The other issue is ticket size. And there, the notion of pooling becomes very important. So if we can pool together the smaller ticket sizes, it becomes compelling for a fund strategy. I would add one other point, if I may, and that is I do think in terms of the potential investor base, I would stretch our thinking beyond just impact investors, which is a pretty narrow investor base. What we're talking about here really is outcomes-based investing. And it's our sense that there's growing numbers of pension funds, public and private, sovereign pools that want commercial returns and real-world impact aligned to the SDGs, outcomes-based investors. This is represented, I think, well in the Principles of Responsible Investment, which is also a UN-born initiative. I should have mentioned them earlier in my list of initiatives to collaborate to a larger extent. But many investors in the PRI are talking about the notion of outcomes and returns. And there again, it brings us back to this wonderful definition, sustainable development investing, and I urge everyone to read that definition. Last point, if I may. My great worry in all this is that this wonderful guide, very pragmatic, will sit on a shelf. And here I think UNDP is going to be so critical in terms of mobilizing the guide, but we're going to need everyone in this ecosystem to really help and get this guide in the hands of capitals and other stakeholders so that we can really move and unlock this market. Thank you.
I'll just actually add one point to that. I think one of the best things that the authors of this guide did was survey a variety of different counterparties who have different perspectives. And I think to the question on what's next, how do you kind of scale this up? I think it's a big part of it is that ongoing connectivity between the various parties who all need to contribute, right? Whether it's the MDBs, the donors, the private sectors, the issuers, and again, this body can certainly be an important convening factor for continuing that conversation.
So, and thank you so much. So I think we're about to close up. I want to give one little answer to your question, Gail, as well. Just because if there's an LDC or a country that can't access capital markets and it's too expensive, these bonds are going to be too expensive as well. So they would need to have some sort of a sweetener, some sort of a support or guarantee associated with them, which is why this whole other discussion of scaling up guarantees for the poorest countries are so important, because the credit of the country still matters here. And so that's still going to matter for the pricing of the bond. So they would really need support. But there may be a case where donors are more willing to support these bonds because they know where the money's going to go. So there could be a link to make that this could be a very good place for donor support, more so than just a plain vanilla bond. Great. And so now, thank you all so much, and sorry for the rush at the end, but we have a closing remarks that we're very excited to hear from Santa Ojiambo, the ASG and the head of the UN Global Compact. Sasanta, over to you.
Thank you. Thank you so very much. And allow me first to say it's been such an informative discussion, and I'm sure we've really enjoyed the insights that have come forward from the panel, from the excellencies, and all of those who've spoken today. Let me just echo also my thanks to DESA, to UNDP, to Sweden, and to GISD for bringing us together, and congratulate you all on the launch of this really important guidebook. Just a couple of key things. I will talk about 3 takeaways. I don't attempt to summarize what's been a fantastic discussion, but I think what underpins most of this discussion for me is that we know, and very much in line with the last comment here, that many developing countries are facing crippling debt, unfavorable risk analyses, and really high borrowing costs. And so, in many countries, interest rates and repayments are forcing them to spend funds that is, desperately needed on health, on education, on infrastructure, on debt repayment. And we really must find a way to get out of this cycle, align budgets better to SDGs, and then really attract financing to areas that isn't available. We know that there's adequate capital around. Capital is seeking a home that will be of value, that will be of outcome, and will really drive forward to the future we want and stronger economies. So it's been great to see a practical guide that gives strong guidance, that represents a full analysis of various stakeholders, that demonstrates the opportunities, the challenges, and really, as Gavin has said, is one that should not sit on the shelf, but really needs to get into the hands of those who have capital and are looking for a place for that capital to land. Global capital markets have grown substantially in the last 20 years, I'm told approaching close to $300 trillion, but not invested enough in sustainability goals and not translating into affordable capital for LDCs, as I said. And to date, private investment in blended finance, too, falls far short of our goals. Time is running out, but we have enough money to be able to solve the problems. There's really such a huge opportunity to make a difference here. Really pleased to see the work of GISD and the continued collaboration across sectors and partners to be able to bring this guidance forward. My three key takeaways from this discussion, I'll just talk about them. There's a huge opportunity to harness global capital for impact and outcomes, and let's not forget that. We need to have strong actions to ensure that we can support debt sustainability as we move forward. Clearly, we've also seen that SDG sovereign bonds are an important signal to investors. We need to signal more to these investors and to internal stakeholders. We need to incentivize performance, and we can expand access to more activity and to deepen and to finance the investor market. SDG sovereign bonds can help us assess data and metrics and assess impact in ways that we haven't done before, aligning with country plans, with integrated national financial frameworks and NDCs and others, and also helps increase credibility for many sovereign states that perhaps wouldn't have that legitimacy and credibility. I think the challenge before us all, ladies and gentlemen, is how to scale what is a growing trend and certainly a topic of interest, so something that can really create the transformative world that we want. And with that, thank you, moderator, for guiding us through such a great discussion. Thank you to all of the panelists, and truly congratulations on this great guide. Thanks.
So I also want to thank all of the speakers for this really excellent conversation, so thank you all. And really, it's been a pleasure moderating this session. As Karen said, this is the beginning. So really looking forward to a continued discussion, more learning, more experimentation, and to come together to take this really to the next level of understanding how this instrument is used, when it is best used, when it is most appropriate, and how to really align investment with the SDGs. So thank you all very much, and we'll see you later. Oh, wait. And I believe there are refreshments outside that are still there for anybody who wants to continue the conversation.